Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches and around Australia on the Community Radio Network. We also go out on iHeartRadio, Spotify, and YouTube. Natasha Panagis is back with us to talk about part 2 when we're talking about contributions into superannuation. And Natasha is a subject matter expert from the Institute of Professionals of Australia. And we've been talking about concessional contribution caps in part 1. Now we're going to cover off the non-concessional contributions and what happens if you exceed those caps. So welcome back to the show, Natasha.
That's right. Thanks for having me back on.
Wonderful. Now, during part 1, we were talking about concessional caps and going into what happens when you get the letter from the ATO saying you've exceeded your $30,000. So just very quick recap, what's the difference between CCs and NCCs?
Yeah, concessional contributions are contributions from pre-tax dollars. So, things like your 12% employer super contributions or salary sacrifice or any personal contributions that you claim a tax deduction for. So pre-tax dollars is concessional contributions, whereas your non-concessional contributions are contributions you make from after-tax money. So it could be money sitting in a bank account that you choose to put into super that's already been taxed and you're putting it into the fund. So pre-tax dollars versus after-tax dollars is the main difference.
That's a great way of putting it. So pre-tax and after-tax. So the after-tax money is money that you've already done. You've paid your dues to the government. So that's sitting there. It's all yours. And I think one of the nice things, we were talking a little bit about this in part 1, is that for estate planning purposes, being able to build up that taxed component in your super balance makes it nicer for the people that may be inheriting this one day when we depart the mortal coil. And I guess estate planning is a big part of what superannuation is all about. Now, when we are trying to understand the NCC cap, I think the best thing to do is let's talk about what that cap is first off. So can you explain, Natasha, what that cap is and why it was there in the first place?
Yeah, look, the non-concessional cap is $120,000 per annum. So that's the non-concessional cap, that's per year, or you could potentially put up to $360,000 into super if you use something called the bring forward rule, and this allows you to contribute up to 3 years worth of non-concessional caps in the one go if you're under the age of 75 and you have a super balances below particular thresholds. So that's your non-concessional cap. And the closer you are to $2 million, once you have more than $2 million in your super fund, you can no longer make any more non-concessional contributions into your fund. However, you can still make concessional contributions into your fund. So that's the cutoff point, I suppose, $2 million. Anything over that, you can't put any more non-concessionals into your fund.
Now, I read in your notes that you sent me through, when people get unexpected triggers for breaching the cap. I'd love to have one of these unexpected triggers. Brilliant. So, more than $120,000 has gone into my super in a year. That sounds like a letter I'd love to receive. So, how does that actually happen?
Yeah, it's a good problem to have, isn't it, if you're putting too much into super? Well, yeah, look, there are a couple of reasons why you might unintentionally exceed the non-concessional cap. The first one is if you've had an excess concessional contribution situation arise and you've left that excess contribution into your fund. So if you leave excess concessional contributions in your fund and you don't withdraw them, that excess amount is going to automatically be reclassified as a non-concessional contribution and count towards your non-concessional cap. So if you don't release those...
That's what we talked about in part 1, wasn't it? So that's when the CCs, they've got the letter and they decide, okay, I'm not going to do anything about it, and that then transfers over into this bucket of money.
Correct. So to avoid having this excess count towards your non-concessional cap, you've got to make a valid election within 60 days of receiving the ATO's excess concessional contribution determination notice, and then you release 85% of those excess concessional contributions, and by doing that, it won't count towards your non-concessional cap. So that's one of the ways you might exceed your non-concessional contribution, because you may have maximised your non-concessional cap for the year. You may have put in 120K of non-concessional contributions, but if you had a little excess concessional, say of $1,000 or $2,000 excess concessionals, and you've left it in your fund, that's going to tip you over and push you over that $120,000 non-concessional cap amount, or lead you to trigger the bring forward rules, and potentially that could cause an issue if you've done $360,000 rather than the 120. So yeah, leaving an excess concessional in there can be one of the main reasons why you exceed the non-concessional cap. There could be other reasons where you might exceed the non-concessional cap accidentally. This could be, for example, where you may have put in a personal contribution into your fund, but then you've had issues with claiming a tax deduction for that personal contribution, and it's been denied.
And so when this personal contribution occurs, I've read in your notes that you talk about a work test. Now, I'm curious when I read about a work test, because I thought that no longer applied. So can you explain to the listeners what the story is around failing the work test for clients that are age 67 and over?
Yeah, look, so the work test used to be in place pre 1 July 2022 for people over a particular age, but the rules changed on the 1st of July 2022, and it's no longer required to meet the work test if you want to make a non-concessional contribution, which is great. Right. And it's really just made it more flexible for older Australians to put money into super. So while you don't have to meet the work test to make a non-concessional contribution, you still need to meet the work test if you're age 67 or above and you're making a personal deductible contribution. So that's the only reason why the work test still applies. If you're over 67 or over and you're making a personal deductible contribution. So you've got to meet that. Otherwise, you won't be able to claim a deduction, and then that contribution will count and become a non-concessional contribution, which is another way how people may exceed the non-concessional contribution cap. So, we talked about the first case where you make an excess concessional and you leave it in your fund, that counts towards your non-concessional cap. But the other way you can accidentally breach the non-concessional cap is if you fail to meet the work test, if you're age 67 or above and you no longer meet the work test, and you can't claim a tax deduction for that contribution, and therefore instead of it counting as a concessional, it counts towards your non-concessional cap. So that's another way. Yeah, that's another way you can exceed the cap.
So tell me about notice of intent timing then and validity issues, because so you've got a letter from the ATO saying you've exceeded your non-concessional cap, but you've actually got to respond within a certain amount of time, otherwise the validity time. So you can't sit on this and do nothing, can you?
Yeah, that's right. So, if you're putting a contribution into super and you want to claim a tax deduction for it, that's going to count towards your concessional cap. And it'll only count towards your concessional cap if you meet two key conditions. The first one is, as you say, you've got to make a valid notice of intent that you want to claim that tax deduction with your fund. So you put in the form to your fund to say, I'm making a contribution that I want to claim a tax deduction for. And you also tick in your tax return to say that I have made a contribution this year and I'm claiming a tax deduction for it. So you've got to do those two things. And if you do those two things, that counts towards a concessional cap. But if you have issues with the timing and lodging the form with your fund or not ticking the tax return to say that you are claiming a tax deduction, then instead of accounting towards a concessional cap, it will count towards your non-concessional cap if you don't meet the timing requirements. There could be other situations that might arise that impact the validity of your notice of intent to claim a tax deduction. That could be, for example, you've got the money in your super fund and then you start a pension. And that pension is you started using some of that contribution amount that's gone in, or you may have done a rollover from one super fund to another, or you may have taken a withdrawal from your fund, or you lodge your tax return before submitting the form. Really important. If you want to claim a tax deduction for a contribution that you put into your fund, and you want it to count towards your concessional cap, you really have to put in the form with your fund straight away at the time of making that contribution to say, this contribution is made, I want it to count towards my concessional cap, I want to claim a tax deduction for it, before you do anything else, before you then roll over to another fund, start a pension, do a withdrawal, split contributions with your spouse. Make sure you make the contribution, you put in your notice of intent to claim a tax deduction with your super fund, and then do whatever you need to do. So
and make sure that
these things.
But also make sure you don't put in your tax return first and then start doing all this other stuff that's going to impact the return that you've just put in.
Yeah, that's it. It's just those two things. You've got to claim, make the contribution, lodge your form with your fund, get acknowledgement from the fund to say, yep, we've got your contribution. Yep, we know you want to claim a tax deduction for it. That's all good. Wait for that acknowledgement and also claim it in your tax return. And then you can go off and do rollovers, do withdrawals, start a pension. People often, don't wait for these things to happen before they do these rollovers, start a pension. So the problem is the ATO view is that contribution that you put into your fund is no longer in there because it's been used to start a pension or do a withdrawal. So this trips people up and causes that contribution that was supposed to be a concessional now treated as a non-concessional because the requirements have not been met.
And that changes its tax status as well.
Correct.
So look, we're about half time. You're here on Dollars and Making Sense, a weekly show about finance, money and investing. I'm your host, Ray Treverson. I'm really pleased to have at the microphone Natasha Panagis from the Institute of Financial Professionals of Australia. We're going to take a short break and we'll be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense. And we have been talking about concessional and non-concessional contributions. This is part 2 of this series about superannuation and what happens when you put money into super, whether it's you or your employer, and what happens if you actually exceed these caps. So we've been talking about excess contributions and what happens to those. Now, in part 1, when we were talking about CCs, you got a letter from the ATO. What happens if you exceed your non-concessional cap, Natasha?
Same thing. You'll get another assessment notice from the ATO saying that this is your non-concessional cap. You've exceeded that cap by X amount. And then the ATO will give you 2 options. So option 1 is withdrawing the extra contributions out. So you can withdraw the excess contributions plus any earnings that they made in your fund over that period. Those earnings are going to, those notional earnings will be taxed at your usual marginal tax rate. But again, you'll get a 15% tax offset to reduce the bill. Now, there'll be no extra penalty tax if you take the money out. So you simply take it out and any earnings. And again, the only thing that gets taxed is the earnings that were generated whilst those monies were in your super fund. That's it.
And again, to reiterate, the reason why there are no substantial tax consequences is because NCC money has already had tax paid on it.
Correct. Exactly right. So you just withdraw the excess amount and you're not going to pay excess contributions tax on your excess and non-concessionals because that's already, as you say, it's already been taxed before. So there's no tax on it. The only tax you pay is any earnings that those contributions would have generated in your fund over that period of time. So you pay tax on those earnings at your marginal tax rate, less a 15% tax offset. That's option 1. Option 2 is you leave the excess contributions in your super fund. And then if you do that, you're going to pay tax at 47% on the excess amount. And now this option is rarely going to be beneficial, which is why most people choose to withdraw the excess amount.
Take it out.
Yeah, to avoid that big tax hit, right? So why Why would you leave it in there and pay 47% tax on the excess non-concessional amount when you can withdraw it and you pay no tax on no tax? The only tax you're paying is, the tax on the earnings it made. It's a no-brainer. So most people will generally take it out rather than leaving it in the fund and paying 47% tax on the excess amount. So they're your two options.
But I guess what's going to happen is if people, the one thing that always amazes me being in the finance industry after being in IT for a lot of my life and, coming up to 10 years now since I retrained and came over into finance, I'm always surprised by how many people do nothing when it comes to their finances, which to me, I just think is counterintuitive, but that's the case. And so if they do nothing, they've got the letter from the ATO, they've been told you've got too much money in your non-concessional contributions and we're going to tax you at 47%. If you do nothing, they're going to slug you, aren't they?
Yeah, that's right. They will. So the ATO is going to send you a letter, and then you've got 60 days to make a formal election on how you want to manage that excess. So, as we mentioned, you can release the excess and 85% of those earnings on those excess amounts, and that's going to, most cases, result in a lower tax liability. Whereas you leave it in there and you pay, you pay 47% tax on the entire excess amount. Now, just important to remember, once you make your election, you can't change it.
That's what I was reading there going, and by the way, if you do nothing and you've passed the time limit, tough.
Yeah, and if you make no response, if you make no election in that 60-day window, then the ATO is going to automatically proceed with option 1, which is releasing the excess and the associated earnings. So I just want to clear that up. So if you make no choice, the ATO is going to do you a favour and say, "Oh, we'll be kind. We'll draw that excess amount."
That is nice of them to do that, isn't it?
I mean, they could. If you made no choice, if you made no election, they could technically leave it in there and slug you at 47%. But no, if you make no response, no choice in that 60-day window, they're going to automatically proceed with option 1, which is releasing the excess and any associated earnings. And then what they'll do is that they will provide something called a release authority, which is like a form that will be sent from the ATO to your super fund that has the highest reported balance. So you might have multiple super funds, but they're going to get that excess. They're going to send that notice to the fund that you have with the highest balance, and then that fund is obliged to follow that release authority and release the money and pay it to the ATO. So that's what happens if you make no choice.
Now, I'm curious, in your notes that you've sent me around the associated earnings, so we're talking now not the NCC component that's been sent back, we're now talking about if that's actually made money in the super fund, they're talking about notional investment returns. And so whilst the ATO is doing you a favour, they're also going to assume, aren't they, that you've made money on this money sitting in this fund, aren't they?
Yeah, these associated earnings represent this notional investment return on the excess contributions while they were held in your fund. So when the ATO works out what these notional earnings are, they're going to calculate it based on the excess non-concessional amount in your fund. There's an associated earnings rate, which is based on something called the average general interest charge for the relevant financial year. So, for example, last financial year, in the 25 financial year, the rate was 11.33%. And the period, the associated earnings period, is going to run from 1 July of that financial year to the date that the ATO's determination notice is provided. So there's a bit of a formula that goes on behind the scenes. There's a method behind the madness in terms of working out what these associated earnings are. And the ATO is going to work that out. And those earnings are going to be calculated according to this formula based on a daily compounding basis. So that's all going to be worked out by the ATO, and it will be provided in the determination notice when the ATO sends that to you to say what your earnings were on those excess amounts.
Now, I'm curious because 11.33% is certainly above, what a lot of bank rates and even fixed income funds, and I run one myself, and we're paying mid-8s. And so if they're saying the notional return on your money was 11.33, I'm sitting there going, well, that's not a bad super fund if they're paying a notional 11.33. But can you actually say to the ATO, look, my money didn't make that much money. I actually only earned 5. So they're assuming 11.33 and they're going to slug you the tax on those earnings at 11.33%.
Doesn't matter what your fund generated earnings wise, earnings rate wise. This is just the law, and this is the way that the associated earnings has been written in and works. So it's based on the general interest charge for that financial year, and it's going to be based on what your excess amount was, and then the period that it applies. So yeah, unfortunately, if your fund did much less than 11.33%, you're still going to have to stick with that and have to pay tax on the earnings at your marginal tax rate, less a 15% tax offset.
So there is a little sting. It's not a huge one. So, you know, if your fund only made 5% instead of 11.3, they're going to assume you made more than you actually did. So I guess the key element, and we're talking about exceeding at this point a $120,000 contribution during that financial year, aren't we?
Yeah, that's it. That's your non-concessional cap for the year. But, you know, you could potentially bring forward 2 years or 3 years worth of non-concessional contributions and have a higher cap if your super fund balance is between particular thresholds.
So I'd like to reiterate the online tools that people have at their disposal. You know, we talked about MyGov. So can you talk through, Natasha, where people look for in their MyGov account, where they're going to find this data about their contributions and whether they've exceeded their cap? So let's say, for example, they've got a letter from the ATO and saying, hey, you've exceeded the NCC for this year. So the first thing they may decide to do is like, let's get some context. What are we talking about? Where is this number sitting? So in MyGov, we were talking about that in the previous show. They can do the same for the NCC, can't they?
Of course, yeah. So you jump into MyGov, you go into the ATO, you go into the tax portal, and under the tax portal, you'll see super. So you can go into super, and then you can have a look at your contribution caps, you know, what they are, and what's available to you. So you can certainly check that in MyGov, ATO, and then look for super and go under the contribution section. Alternatively, you can log on to your member account with your super fund online if you're part of a large APRA fund or a retail fund, or if you run your own SMSF, it'd be worthwhile to speak to your accountant who might have visibility of what your contribution caps are, or your SMSF administrator if you've got one of those. So there's certainly ways to track what your contributions are, what your contribution limits are, and what you've made and what your super balance is. But look, if you've exceeded the cap, the non-concessional cap, and you want to release it, then again, you can make your election online through MyGov. So again, if you've linked your MyGov to ATO online services, which is where you're going to go to check your super, then you can select super and then manage your non-concessional contribution election. So you can do it that way, or you can speak to your tax agent. They can also lodge the election to release any excess amount through their portal for agents. Or you can do it the old school way again and do it via a paper form. And, you know, once that election is accepted, the ATO is then going to issue your super fund with a release authority to the selected fund that you've chosen. And the fund is obliged to follow that. So once the super fund gets that notice, that release authority from the ATO, they must respond to the ATO within 10 business days and pay that amount to the ATO. So, you know, just remember, you can release that excess amount from an accumulation account that you might have, or a pension account, a super pension account that you might have, or multiple accounts. So it's really up to you, and it will just depend on which fund might be most appropriate to release that excess from.
And I guess one of the things here in reading your notes that you sent through to me, your final thoughts, exceeding the NCC cap doesn't automatically result in harsh tax penalties, but how the excess is managed can significantly impact a client's future tax position and estate planning outcomes. So by understanding the practical implications of each option and obviously going through the nuances, they're going to hopefully take the best tack. And like always, consult somebody that knows what they're doing.
Exactly. Look, I think just to round off, yes, exceeding your cap can be stressful, but the ATO has a process to help you manage it. Really important to understand your options, act quickly because you've got time limits, and just to make sure that you're paying the least amount of tax as possible and keeping your retirement savings on track. Couple of tips to avoid going over the caps: track your contributions, check with your employer and your super fund to see how much has been paid into your fund each year. Consider your timing. When you're making contributions into your fund, it's going to count in the year that your super fund receives them, not when you make them, because sometimes there can be a bit of a time lag between when you make a contribution and when it is received, especially if you're doing it, over that end of financial year period. What's your bring forward rule, particularly for non-concessional contributions? If you trigger it, you can't make any more non-concessional contributions over the next, say, 2 years if you're doing the 3-year bring forward rule. And lastly, just use ATO online services as well. You can link your MyGov to the ATO to see real-time contribution information. And look, if you're unsure of next steps, obviously there's options to speak to your financial advisor about that, or your tax agent who have visibility over your contribution cap history and your super balance as well. So get some advice if you're unsure.
Natasha Panagis from the Institute of Financial Professionals of Australia, thank you so kindly for being on Dollars and Making Sense. Until next time.
Thanks, Ray.